Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. We're counting down to the next VRIC, January 21st and 22nd. My name is Jesse Day, and for now, we're bringing the VRIC to you with our expert online panel series. And we've got a great one lined up today. We've got Don Durrett of goldstockdata.com and John Feneck of Feneck Consulting to talk gold and silver miners. Gentlemen, welcome to the program.
Hey, Jesse, thanks for having us on.
Thanks, Jesse.
So let's start with a broad overview of the gold and silver mining space as it stands right now. I'd like to get your perspective on both the majors and the juniors, how they're looking to you at the moment. Would you say they're undervalued across the board? Is this a time to exercise caution in anticipation of further pullbacks? Somewhere in between, I'd love to get your view. And Don, I'll start with you.
Well, I'm a long-term investor. I don't invest for the short term for say the next year. So as far as I'm concerned, this is fantastic buying opportunity. I've lived through some of these corrections before, and I've found the best time to buy is now. People are afraid to buy these dips because they think they're going to catch a falling knife. So I say, you buy to the bottom. I'm super excited right now to buy a few of these stocks that are on sale. All the silver miners are on sale. Most of them are 5, 10, 20 baggers, which is insane right now. I have Coor printing as a 20 bagger, which it's unbelievable. And, I think it's down like 350. I mean, these are just, there's sell prices. I'm not concerned about, this is a 2013 occurrence where you basically get a sell-off and you stay in a bear market for 6-7 years. I'm not worried about that. I was talking to somebody yesterday, and he's a little concerned about how long it's going to take for the miners to come back. Me, the longer it takes, the more I can buy. So you talked about the majors and the mid-tiers. Now, not all the majors are cheap right now. Some of them are. I'd be focusing more on the mid-tiers. And then most of the mid-tiers are cheap. There's a few in Australia that aren't, that I'm somewhat frustrated at, because there's some Australian mid-tiers I'd like to own, but they just haven't come down. And so it kind of gives me a bit of a signal. Companies like Gold Road and Capricorn, and I love to buy these stocks on sale. But I value these companies using future gold prices and future free cash flow. And they're just not juicy enough for me yet. Evolution's getting close, but it's still not juicy enough. But I'm looking, so we're not in complete, bloodbath yet for across the board. I would say that the majors and some mid tiers are still a little pricey. We might get some other, but there are a lot on sale. My goodness, there's a lot of juniors on sale, crazy prices. For me, I want to buy some more Avino and some more Coor right now. Those are the two to me that just look super juicy. I think Avino's under 50 cents. It just, my eyes pop open. Now, I'm not, I think we're going lower here. I do. I last night I tweeted that 1,800 on gold is not going to hold. I was been praying. I've been saying this for months now. I'm praying that 1,800 holds. That was the number I really wanted. But I don't think 1,800 holds here. So now it's kind of hard to know how low we're going. Is it going to be 1,775 or 1,770 or lower? But I don't think 1,800 holds here. So we're going to get more buying opportunity.
Well, I definitely would like to dive into discussing the macro picture for gold a little bit later. But first, John, what's your view, your broad overview of the gold and silver mining space at the moment?
Yeah, so I think all of us came out of Beaver Creek and Denver Gold pretty pumped up, as we always do, and GDX was printing at 30, at least at the first conference there, second week of September, and now is printing below 26 as we speak, which is hard to believe in 3 weeks. And this is what frustrates investors, right? You get these series of head fakes since the August 2020 highs that traps investors, for lack of a better word, and then they have to deal with, what do I do here? So I take a little bit of different approach to Don, in that we are looking very short term as well as long term. We like to buy stuff as core holdings for 1 to 3 years, but we do trade on the periphery, and we see a lot of tradable opportunities here, both in the junior space and in mid-tier space that Don just mentioned, right? We don't mind buying an ASM at 48 today and dumping it at 60 in 2 weeks. I mean, because I don't really have a relationship with the company. And I do think that silver is going to take a little longer than probably Don does to get going. We've been saying all year that 26 has been problematic, and it continues to be problematic all summer and all fall. 26 an ounce for silver, that is. So will we get through that yet next year? Absolutely. But in the meantime, I'm really concerned about my performance, and I want to be sure that I'm doing the best I can every single day, which takes a lot of work. To getting back to your question, Jesse, GDX at 26 here, 26.59 was broken yesterday with some authority, and that was the year-to-date low. So that brings in lower prices, and probably somewhere between 24 and 25 will hold. But 21.57 is the 3-year low. So I don't believe we're going back to 21.57, which is September of last year. I think we're making what we call a higher low on the 3-year chart. So somewhere in the 24 to 25 range, hopefully GDX will bounce there and bottom. But to Don's point, the price action here in gold, man, really frustrating over the last couple of weeks.
Well, let's hone in on silver for a moment because there are very few silver-focused mining companies to invest in compared to gold. So I first wanted to get your current view of the macro picture for silver, how you see it positioned, and how you personally invest in the silver space. Are there any Don, you mentioned that silver miners are quite undervalued at the moment, so I'd like to hear more about that. But this time we'll start with John. Give us your take.
Well, as I just said, silver for us has been a top 5 holding for quite some time. But as I point out to my followers, that position was built in April of 2020, May 2020, when things were getting really smoked, as well as earlier than that. So we haven't added to our silver position since then. So it still remains a very large part of our portfolio because I do think that silver has torque. And when you look at the gold to silver ratio, which is an ounce of gold divided by an ounce of silver, you're trading at 86.3 yesterday. Anytime you get to 90 plus on the gold to silver ratio since 1980, it almost always indicates a buy for silver or silver equities. To Don's point, these silver equities are getting so bombed out here that you could really do some homework over the next week or two and pick some. And by next year, you're going to be very happy, right? Because silver is going higher. It's just that, again, we think 26 has been really problematic. Every time we get close to 26 an ounce, there's sellers. And that's frustrating because there's major resistance at 30, right? So we've got to get through these technical areas with some authority, and that will get us more excited.
And Don, your view on the silver space at the moment, and talk to us about the value you're seeing in the equities.
Sure. So even at $25 silver, the sector isn't healthy. And so we're under 22 right now. So the sector is, highly unhealthy at the moment. So the longer we stay under 25, it's kind of brutal. I mean, stocks like First Majestic, they can't do anything. They're kind of stuck. And so we're in a really unhealthy area right now. And it's very frustrating for investors to have paper losses, and nobody wants to buy when you see these companies with no free cash flow. Some of this, a lot of these smaller silver producers are getting just, if they have to go like a quarter at $22, they're going to get brutal. They're going to have a brutal financial, and then their share prices are going to go down even more. So a lot of this is, the longevity of these low prices. How long is it going to take to, John mentioned 26, 25, 26. I think we got to go all the way to 27 before the market actually can breathe a little bit. And if you get to 27, the way that the technicals are set up, you really go to 30. I think once we get above 26, I think John's number is kind of spot on here. Once you get above 26 on silver, I don't think it stops. I think within 3 months you're above 30, and maybe within less than 3 months you're above 30. We're basically, we're in this significant correction here, but once it turns and once we get above 26, we're probably off to the races heading to 50 or higher. I mean, it's like the whole thing's going to turn on a dime once you get above 26. So for me, again, as a long-term investor, I'm just looking for opportunity here. So I'm buying when the HUI got under 225. My target was originally it was 200 to 210, I think. Then I lowered it to 195 to 205, and then I lowered it again 180 to 190. So over the last 3 weeks, I've lowered it. Keeps going down, down, down. But I've always been in the 200 camp on the HUI. I always thought we were headed to 200. We traded 205 last week. We traded under 200 yesterday. So my target's been right. I've been very bearish for 18 months on gold and silver miners because until the stock market breaks down, and capitulates, I just felt that gold and silver were trapped here because Wall Street's not going to buy gold unless they have to, and they only buy gold when they're afraid. And so for me, the only thing that's going to turn that is the stock market falling. And today we're close to 4,200, and I've been saying this. 4,200 is the most important level for this entire year. If 4,200 holds, gold and silver are they're in trouble. They're not going to break out. And so we need to go below 4,200 to basically get this fear trade back. And so we need Wall Street to become afraid. I saw a guy in today. It was unbelievable. I always stretch in the morning and put on the cable news to see what's going on. This guy said that a bear market is starting right now. Get ready to buy. And basically his whole, I guarantee you, his whole analysis is based on the Wall Street theme right now that 4,200 is going to hold and that the fourth quarter is going to hit its historical norm, which is up. They're anticipating earnings to be up 10% in Q4 and everything to be rosy heading into January, heading into this bull market. Well, I'm not in that camp. I believe Q4 is actually going to be, if we go below 4,000. So the whole key here, again, 4,200 is such an important level. We go below 4,200 and people start jumping off this ship. Then you get below 4,000. It could be a bloodbath. And then for me, it's like, when does gold or silver bounce? And once it bounces, I think that's when the fear trade gets recognized that it's there. Right now we've just seen this total bloodbath over the last couple of weeks, gold and silver. And it's primarily for a combination of things. It's not just the dollar going up. Yeah, the dollar's going up, definitely. And that's not helping gold. And interest rates are going up, not helping. But the two other factors that are very, very significant here, one is sentiment. And it's sentiment, and this is where fear comes in. Sentiment and do I need to own gold? No, I don't need to own gold. The market's going to take off in Q4. What am I afraid of? So sentiment is in the toilet for gold right now, and that's one of the reasons why it's dropping. So you got to use all three factors. You can't just, it's the dollar, it's the dollar. No, that's not the only. It's a combination of factors.
And what about your thoughts on a higher interest rate? Oh, sorry, John, did you want to add something to that?
Real quick. So, I agree with Don. We've been saying since May of this year that 4,200 was, an important level. And if you look at the 200-day moving average right now, it's right around 4,200. So the price action this morning, when the JOLTS number came out, that's JOLTS job openings, the market just tanked. I mean, it was immediate and it's fed on itself. So what I've noticed since September 20th Fed meeting is that the market can't have a sustainable rally. I mean, go back and look at every single day, pick your favorite index, the Russell, the S&P, the NASDAQ, they are failing. And that is a new dynamic, right? Because we saw May, June, July, August, this euphoric move into tech and AI. That is starting to get faded now. Start to look at those Apple charts, those Amazon charts. These charts are starting to turn over. And so that's really encouraging for me because I'm in the camp like Don that we need to see the market get lower, what we call a sector rotation, out of momentum and into value. And I think that's coming.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Very interesting observations. I wanted to get your take as well on interest rates potentially being higher for longer. There was quite a long period of time during this year where people, particularly a lot of gold bugs, were saying, the Fed's going to be forced to capitulate here at some point. They're going to cut rates. When they do that, gold will take off. However, we are seeing signs that they are intent on this 2% inflation target and that they've been quite hawkish recently, pointing to the fact that there may be some more rate increases up ahead, maybe not as many cuts as people are anticipating next year. So, Don, I'd like to get your thoughts there. Could that be a headwind for gold if rates stay higher for longer? And how do you expect things to play out in regards to Fed policy?
I think the higher rates is manna from heaven for the gold. And the reason why is because the US economy has basically been built on debt, built on leverage. And these higher rates are basically putting the US economy in peril. And I think the Fed is basically putting themselves, they went too far with raising rates, and now they broke the system. And I don't think Wall Street realizes how much damage these high rates have caused. And gold just sitting back there laughing, going, "Oh, you guys, thank you, thank you, thank you." The combination of high rates in the Ukraine war flipped the switch on gold. I basically been bearish for a long time on gold, because the economy is basically, as long as the economy is clicking along at 2%, nobody cares about gold. Gold gets its juice, if you will, from fear. You have $100 trillion plus in stocks, $100 trillion plus in bonds. That's where all the money goes. And of course, you got real estate as well. That's where all the money goes. The money doesn't go into gold. It's a small, small percentage. The average investor doesn't own any gold stocks, doesn't own any physical gold because they never had to. This is a paradigm change. And the high rates and Ukraine war, which changed the whole global dynamic in international trade, has put the US economy in peril. And nobody's talking about it. Your mainstream, they're not going to talk negative. They're not going to do that. They're not going to scare people. Everything's going to be spin. Everything out of Wall Street is going to be spin. Buy stocks, everything's fine. Spin, spin, spin. They're not talking about these underlying factors. The only place you learn about that is you go out on your own and you watch podcasts like this. People like me who've been studying this stuff for 20 plus years, and I actually been studying for 50 years, maybe 40. But if you look at what exactly is set up right now for the US economy, the Fed is creating inflation by these high rates, which is ironic, right? The high rates are supposed to stop inflation, but it's actually creating inflation because there's so much income from these interest rates, and that income is getting spent. They're actually sloshing money in by having 5% rates. And then on top of that, the federal government, they're actually stimulating the economy as well with the $2 trillion deficits, which is creating inflation. Now the Fed is in a, Luke Groman called it last week. He said they're in a doom loop. And so if they keep rates high, inflation doesn't go away, and the economy has a huge headwinds. Like John said, the market cannot sustain a rally. Then simultaneous to that, the other side of the doom loop, if the Fed does lower rates, then they create even more inflation because they kind of speed the economy up a little bit instead of kind of pull the rug out from under it. So they're trapped. We've been talking about this is coming. I'm saying that next year in 2024, we are going to lose our confidence in the economy, and everything's built on confidence. So you have 2016, we lost our confidence in politics when Trump was elected, and the mass media, basically we didn't accept him as our president. And then the whole political system basically broke in 2016. Then in 2020, COVID came and we lost our confidence in institutions. I mean, who believes what the CDC is saying? We don't believe it. We don't believe what the government. We don't trust our government anymore. Then 2024, next year, we're going to lose our confidence in the economy. That's my call. And when that happens, I don't believe we're going to return to normal. And we don't return to normal, then what's the new normal? And in my opinion, gold's going to benefit big time from the new normal.
Very well said, and a fascinating breakdown. John, your view on where interest rates are headed, what is going on with the economy? Obviously, we're in unprecedented times, as Don mentioned. when it came to COVID as well. We saw an unprecedented level of stimulus injected into the economy, pandemic checks, stimmy checks, a lot of that spent on speculative assets. A lot of that people are pointing to is still, people still have some of that money. How do you think that will affect things, and what does that all mean for gold?
Well, I've been in the camp, unlike many of my peers, that last June I was on at PDAC, interviewed by Kitco, saying that the Fed means business. And David Lynn paused and said, "That's interesting because like everyone else I've interviewed in the gold and silver space has been talking about cuts." And if you look at what's happening with the Fed voting members or just the Fed members in general, coming out of September 20th, just the most recent, meeting, 12 are calling for another 25 basis point hike by the end of the year. So, to me, the Fed is going to raise another quarter point here between November, December, and January, one of those three meetings. And that's what they've said, right? So they said this at the summer meeting, and they follow through with 25. I think it was in July, and now they're going to do another 25 somewhere. But will it be enough? And like to Don's point, they've already destroyed, certain areas of the market by doing what they've done. So we've been short real estate, things that are interest rate sensitive. Look at the TLT. We pointed that out to clients 2 weeks ago when it was at 93. I said, look, this thing's got a low of 91 point whatever, 91 and change. And it's the 3-year low. If this breaks, real estate is an awesome short here. And that's the 20-year Treasury ETF, right? And you're seeing that made a new low today, a new 16-year low. So when you look at these kind of lows, it's like, wow, the dollar's raging higher, the Treasury market's very wobbly. The broad market is now selling off on little news items like jolts, which it did not do all summer, right? You have to look at this as a technician and say, man, I better start rethinking my thesis for the rest of the year because I don't think it's going to be very rosy if you're in the broad market. We can go through this on another show, Jesse. Maybe you can have us back on. But I mean, all of the short ETFs that I'm in are all breaking out or are just about to break out right now.
Well, let's shift back to the mining space and mining stocks because I'd like to get your views on jurisdictional risk and how to mitigate it. So when it comes to investing in the gold and silver mining space, are there any areas of the world you avoid due to political risk? Do you spread out the risk by being diversified in your geographic exposure? How do you approach that? Don, I'll go to you on this one.
Yeah, before I go to that, this is probably going to be a long answer. I'm going to stick something in. I want to talk a little bit about the Fed because I think this is really important. And this is something that Wall Street's ignoring. Everybody's ignoring. I'm basically it's the reason why I'm in gold, because I just think people are ignoring reality. Until the year 2000, the Fed basically had two mandates: full employment and price stability. That was their mandate. Right. Well, once 9/11 happened and the great financial crisis happened, that mandate changed. And they don't talk about it. Nobody talks about it, but it's true. If you look at the stock market from 2009 to 2020, every time the stock market had any drop at all, you had this injection of money every time. Why? They basically didn't want to allow a recession, and they didn't want the stock market to melt down. They didn't allow it. So their mandate, to me, changed, and now they have a third prong. And that third prong, in my opinion, is the most important prong. And that third prong is maintaining the stability of the economy. And the stability of the economy, the stock market is the economy. So right now they're saying that they don't care about a correction. And you know what? They don't care. And so if we go down to 4,000, the Fed's not going to do anything. But you're missing the point. They do care about it. But the reason why, let me explain this, is that the reason why, John said they're probably going to raise another quarter point. And the reason why is they want their tools back. They need their tools back in order for this third prong. And right now they don't have either tool. And those two tools are the ability to lower rates to zero and the ability to print money. They don't have either of those tools. They're trying to get them back. So since stability is their number one priority, they got to get the tools back. So if the tools are, in other words, inflation isn't the number one thing here. They're not raising rates so much to create inflation. They're raising rates to get their tools back. And they're scared to death that the economy is basically going to go into meltdown mode and they don't have their tools. And they don't. They've lost control. And that's my point. The Fed has lost control. That's what Luke Gromen's saying. I think he's spot on. Next year, we're going to see the outcome of that. Okay, there's that. Now let's go to jurisdictional risk, which is actually an easier question. Now, in silver, the big problem with silver is Mexico is no longer a mining-friendly country. You have a lot of, we really can't trust him on permitting, especially open pits. We don't know what the kind of status is in permitting in Mexico. My point is in silver. So the 80% of, I don't know, 80 may be a big one, 70% of probably my silver portfolio is in Mexico. That's where all the big silver mines are. So you have this jurisdictional risk in Mexico, and there's really not a lot you can do to diversify. I'm going to try to sell my Mexico stocks, early. That's how I'm going to diversify, get out early. But in silver, I mean, you don't have a choice. I mean, there's 0 large silver mines in Australia, 0. They're building one, but it's going to take 2 years. You got the Alexco mine in Canada, but there's basically no big silver mines in Canada either. And then you have a few in the US. Those are your 3 jurisdictional safe havens, right? And there's not a lot of silver anywhere else. So you have that problem. Silver is a problem for jurisdictional risk. That's why I like Heckler & Koor, because the institutions are going to be buying them like candy once silver's above 30 because of the jurisdictional risk. And this is what people don't realize, is that Heckler & Koor, which is going to be getting completely obliterated here, they're going to be the institutional darlings once silver goes up because they want to avoid Mexico, or they don't want to be overweight Mexico because we can't trust it anymore. So you got that. So now gold. There's a lot of countries in the world that I avoid. Like, I've had bad luck in South Africa. I won't touch it with a 10-foot pole. Anything in Central Africa, South Africa. I like Namibia, which is in South Africa, but I won't touch Botswana. Lots of places. Western Africa is becoming a big mess. There's been a coup there every other month lately. I like Cote. I like Ghana. Everywhere else, I'm a little nervous. But I do like West African stocks, but you got to kind of hold your nose and take your chances. East Africa, I don't particularly like. I think one play in Tanzania, but you got to be trouble. A lot of these Asian countries are getting more risky. Indonesia, the Philippines, the risk is increasing. I avoid the Russian. I avoid Russia. I avoid the Russian satellites. Eastern Europe is starting to get me more nervous. I did buy Adriatic. I've had a lot of bad luck in Eastern Europe. Spain, I've had a lot of bad luck, but I just, I have a play there just by Denarius, but there isn't anything else in Europe. I don't mind Ireland. Ireland's pretty good. Finland, up in the Scandinavian countries, I think are fine. But on the whole, one final point on jurisdictional risk. I think people are really missing the boat on the premiums that are going to occur once gold and silver break out and the money starts flowing in the sector. When I say premiums, I'm talking about multiples. Free cash flow multiples, net profit multiples in areas such as Australia, the US, and Canada. So I love the Aussie mid-tiers. I like any mid-tier single company in Canada. I think the premiums are going to go nuts, and I think people are really underestimating it. That's the reason why I can't buy these Aussie mid-tiers cheap right now. Go look at the Capricorn and Gold Road. Go look at the prices. They're just not for sale right now. And that people are already paying premium for Aussie stocks. Just think what they're going to pay down the road. I mean, the West Golds of the world are going to get the same premiums, the Capricorn. I think you're going to get 20 to 30 premiums in Australia for the mid-tiers when the average historical is about 8. So you're going to get 3x on your money. You're talking about multiple expansion on Wall Street. Who gets a 3x expansion? That's what we're going to get with some of these mid-tiers in Australia.
John, your views on jurisdictional risk and how you deal with it.
Yeah, and that was a great answer, so I'll keep it brief.
Yeah.
I mean, I agree with a lot of that. It has been much more of a challenge, I'd say, since COVID to identify parts of the world that are investable. And you can go through a list, but let's take Peru, right? Castillo ruined Peru. Silver is huge in Peru. Copper is huge in Peru. So a lot of these companies were affected negatively. Interestingly, Castillo got jailed last December. There's been a new woman in power in Peru all of this year. And from the 3 different Peruvian CEOs that I talked to this month, they say it's going well. So like I'm looking at that as a value manager and saying, okay, these companies got really trashed on the way down, but haven't really rebounded yet. But things are looking better. They're not great, but they're better. And so as a value manager, I'm looking at something like SilverX and saying, okay, these guys had to stop production for 30 to 45 days. They just went back into production September 19th. I think they have a shot at being cash flow positive this quarter if silver, just plays ball, right? I mean, they've done exactly what they were supposed to do. Basically reduce headcounts, work with the government to get, what they needed to get done, and take a pause, right? Rather than just producing at a loss, right? Which is what a lot of silver companies do, as Don knows. It's like that's not really a strategy when you're a junior. You have to be prudent. And so I think, Jesse, it's really a company by company situation sometimes, not just a jurisdictional situation, and really doing that homework and talking to management.
Great. Well, it's been an enlightening conversation. Thank you so much for joining us today. Don, you have something to add?
Yeah, I had a follow up on Peru. So, I actually am going to add to a stock down there, Kuya, which is currently priced at $17 million. And they're getting ready to, they're trying to produce 2 million ounces a year, 1.8. A 1.8 million ounce producer, and they're valued at $17 million. And they have this discovery that they just made in Ontario, which was a pretty significant drill hole, 3 meters, like 15,000 grams per ton. So, yeah, I mean, Peru, definitely some risk there, but some opportunity as well. Like he mentioned SilverX, I do own SilverX, but I like it. Look, Kuya at 17 million. I'll take the bet. I mean, if they can become a 2 million ounce producer, and then who knows? Then they can grow the company from there. But yeah, so I actually don't mind gambling a little bit in some of these high risk companies.
Yeah.
Great. Well, gentlemen, John, go ahead.
Don, you had mentioned to me Silver Tiger just I guess a week or two ago. I just talked to them last night, and they were kind of surprised that their MRE, their mineral resource estimate, wasn't, I guess,
well received
by the market. But it's been a tough time, right? You're obligated as a company to put out news when you have material news, right? You don't have a choice. So some of it is just bad timing, and their PEA is coming this month. So that's another one that's on my radar, because it again is like run by a guy who's a former securities attorney. Like, you look at who manages these companies, and I like people that come from those type of backgrounds or capital markets background like myself, because they understand how to manage capital. It's not just about having a good mind. Look what happened with Alexco. Like you pointed out, Don, Hecla bought them for pennies on the dollar because they couldn't get it done. It's like they had issues with water. They had issues. Yes, everyone has issues, but they should have taken more money at $2, $3, whatever, and they didn't. So they ended up having to sell, right? And it's like Phil Baker at Hecla now wins. And so it's like you have to be able to look at those kind of things and say, these are great opportunities, because Hecla is one of the oldest mining companies. I think it's the oldest mining company in the U.S., right? So it's like, to Don's point, Jesse, I think you're going to see next year people being more selective with where they allocate capital.
Yeah.
Well,
I do think.
Yeah, go ahead.
Final.
Yeah.
I think that people are really dismissing Silver Tiger because it's in Mexico. It's a beautiful story. They made great progress. The future, their pipeline, it checks all the boxes except for the location. We're talking about jurisdictional risk. But yeah, if Mexico doesn't, if they start trending better, if you will, towards, not so mining unfriendly, they start, giving some of these permits out. We're going to find out in the next 6 to 12 months exactly what the permit issues are in Mexico. Minera Alamos is right at the top of the list. They're trying to permit a mine right now. There's a couple others that are right there trying to permit. Discovery just started. So, we're going to find out here pretty soon. And That's going to change a lot of the jurisdictional RICs in Mexico. And more money is going to flow into companies like Silver Tiger.
Don, tell us about goldstockdata.com, what it's all about, what service you provide there.
Oh, thanks, Jesse. So my company it's a combination of data. So I have about 850 gold and silver miners in my database. So my database is very extensive. It's got a really, good source of mining stock information on that. But in tandem with that, I create an analysis of every company, which it's about 3 or 4 paragraphs of each company. So you just get a quick overview of what's Don's views on this company. Plus, I rate them. I have my own rating, an upside and a downside rating. So you get the analysis, the rating, and the data, and then you also get a newsletter with it. So it's a really good resource. And you can follow me also on Twitter, Don Durrett, and then on Substack. Also Seeking Alpha. Those are kind of my 4 places. But thanks for letting me shout that out.
Yeah, absolutely. I'll put links to all that in the description below. John, could you tell us about Feneck Consulting and anywhere else you'd like to direct people?
Yeah, sure. That's our website, fenneckconsulting.com. If you go to the performance tab, I'm very proud of that. We're about to post our September 30 numbers. We're ahead of GDX and J. I know that much so far for the year to date number, which is great. We try to manage downside risk in years like this where it's just been tough to generate alpha. You have to be able to build some cash at certain times and, just observe things as opposed to just jumping right in. I would just echo Jesse, since we've interviewed, a couple times here in the last 2 years, that this is the time you want to align yourself with someone like Don or myself. Like, this is the time. You can't time an entry point perfectly. I have made so many bad first entry points, I can't even tell you. It's a long list, but I don't get it wrong over time, right? My numbers speak to that. So if I buy something like Forum that you've interviewed before, Jesse, I think I introduced you guys in the summertime, the stock was getting crushed, right? It was at 4 cents US. And I went on, I think, your podcast and said, this is an insane price, which I never do, as you know. But now it's at 13 cents US. And so you can make incredible money if you understand that Rick Mazur's been in uranium for 40 years and this guy's going to get it done, right? And you have to make these phone calls, or you have to align yourself with someone like Don and I that are making these calls, that are taking time out of our life to go to multiple conferences and meet with CEOs and try to get that data, through either my site or Don's site.
Great. Well, I'll put a link to Feneck Consulting in the description as well. Once again, it's been an honor, gentlemen. Thank you so much for joining us today.